Welcome, aspirants. If you're prepping for your exams, you know some topics are just pure gold, and you absolutely cannot skip them. Well, the RBI's new directions on gold loans, that's one of them. So today, we're going to break it all down, piece by piece, to make sure you're totally ready for exam day.
So, first things first, why the big change? You see, for the longest time, the gold loan market was kind of a wild west. The rules at a commercial bank were different from a co-op bank, which were different from an NBFC. It was this confusing patchwork that wasn't great for borrowers and created an uneven playing field for the lenders themselves.
To sort this all out, the RBI stepped in with what they call a harmonized framework. And the goal is pretty simple, really. It boils down to three things: creating one single rulebook for everyone, closing all those loopholes and gaps, and most importantly, beefing up the protections for you, the person taking the loan.
Okay, let's dive in. Here's our game plan for today. We're going to start with who these new rules actually apply to. Then we'll get into the key jargon you absolutely have to know. From there, it's the heart of the matter, the new lending rules and the all-new borrower protections. And we'll wrap it all up with the key takeaways you'll want to have memorized.
All right, first up, one nation, one gold loan rule. Let's get a crystal clear idea of who is covered by these new directions and, maybe even more importantly, when they have to start following them.
So, and this is the main point, these rules are sweeping. I mean, they cover pretty much every regulated lender in the country. We're talking commercial banks, regional rural banks, small finance banks, co-ops, and, yep, all the NBFCs too. It really creates a level playing field. And that deadline? Mark it on your calendar. Full compliance is required by April 1st, 2026. You know, with any new regulation, you've got to learn the language, right? To really get what's going on, you need to understand the key terms. So let's quickly break down some of the jargon that the RBI has now officially defined.
First up is eligible collateral. This is a super specific term. It means things like your jewelry, ornaments, or coins. What it does not include is primary gold. So no gold bars, no bullion, no raw biscuits. That's a really fundamental distinction to remember.
Next, we have the LTV ratio. You've probably heard this a million times, but it's at the absolute core of any secured loan. It's just the amount of your loan divided by the current market value of the gold you've pledged. Simple as that. It's a key number that lenders have to keep an eye on.
And finally, a bullet repayment loan. The name kind of gives it away, doesn't it? This is where you don't make any monthly payments. Instead, the whole loan, the principal, and all the interest that's built up is paid back in one single shot, one bullet payment, right at the very end.
Okay, now we're getting to the real heart of it, the actual rulebook for lending. This is where we'll see exactly how much you can borrow, for how long, and what the key restrictions are. So you'll want to pay close attention here.
Now, this is one of the most fascinating changes, a new tiered LTV structure. So instead of a one-size-fits-all rule, the RBI has gotten smarter. See this? For smaller loans, up to 2.5 lakh rupees, you can get a higher LTV of 85%. But as the loan amount gets bigger, the LTV actually steps down, first to 80%, then to 75%. It's a way to manage risk.
And this chart just makes it super clear, right? You get this step-down system, more borrowing power for smaller needs and a bit less as the loan amount gets bigger. You should definitely memorize these three numbers, 85, 80, and 75%. They are prime material for an exam question.
And here's another key number for your flashcards. For those bullet repayment loans we just talked about, if you're taking one out for consumption purposes, the absolute maximum term is now capped at 12 months, 1 year. That's it. Simple, easy to remember.
Now pay close attention to this one because this is a really important little tweak. The general rule is still no loans against primary gold like bullion. But the RBI has carved out a very specific exception. Certain banks can now give working capital loans to jewelers against primary gold, basically recognizing that for them, it's raw material. This is a very key nuance. The new rulebook also brings in some other important guardrails. For one, lenders can't take your gold and then pledge it again to get a loan for themselves. You, as the borrower, have to declare that you're the rightful owner. And for the first time, there are clear weight limits. 1 kilogram for gold ornaments, but a much smaller 50 grams for gold coins per borrower.
Next up, the RBI has seriously strengthened the rules for how your valuable gold is handled. This whole section is about making sure your collateral is managed, valued, and, if things go wrong, auctioned off in a way that's fair and totally transparent.
The way your gold is valued is no longer some mystery. It's now completely standardized. Lenders have to use the lower of two prices, either the average price from the last 30 days or yesterday's closing price. This is a conservative approach to stop overvaluing the gold. And another thing, only the pure metal value counts. No extra value for stones or fancy designs.
And in a worst-case scenario, if a loan defaults, the auction process is now highly structured to protect you. It starts with proper notice, public ads, and, this is critical, a reserve price that can't be less than 90% of the gold's current value. Plus, if the auction brings in more money than what you owe, that extra cash has to be refunded to you, and fast.
Now here's a number I would put a big star next to in your notes. This is a really powerful new rule for borrowers. If a lender drags their feet in returning your gold after you've paid off your loan, and it's their fault, they have to pay you a penalty of 5,000 rupees for every single day of delay.
And that penalty is tied to a very strict deadline. The rule says the lender has to release your collateral the same day you repay the loan. They do have a little wiggle room, a maximum of 7 working days, but after that, that 5,000 rupee a day penalty kicks in. That's a huge incentive for them to be quick about it.
Okay, we have covered a ton of ground, so let's wrap this up by boiling it all down to the most critical, high-impact points you need to have locked in your brain for the exam. Think of this as your final revision checklist.
And here it is, your final cheat sheet. Let's run through it one last time. A harmonized framework for everyone. The 3-tiered LTVs, 85, 80, 75%. A 12-month max tenor for bullet repayment loans. The conservative valuation method. A minimum 90% reserve price at auction. That very powerful 5,000 rupee per day penalty. And that very specific exception for jewelers. Burn these points into your memory.
And that's a wrap on our deep dive into the RBI's new gold loan framework. We've gone through all the rules, but the bigger question to think about is what happens next? How will this massive effort to standardize rules and protect borrowers actually change the gold loan market for millions of Indians? That's the story we'll be watching. All the best for your exams.